Every week, data is put out about mortgage applications. It gives us a sense of how busy the market for a new mortgage or a refinance mortgage is. As part of that data, we are finding out the numbers of people who want a traditional mortgage with a locked in rate, or those people who would like to go the way of an adjustable mortgage or an ARM. Recently, activity around ARMs has been on the rise. Those mortgages tend to be riskier propositions for the homeowner due to how the rate can fluctuate. As to why this is going on right now, pleasure to be joined by Ben Keys, who is a Wharton real estate professor. Ben, great to talk to you again. How are you?
I'm doing well. Thanks for having me, Dan.
Okay, so is this a blip on the radar or the start of a trend?
Well, I think this is a symptom of an incredibly expensive housing market. Right now, house prices are extremely high, mortgage rates remain frustratingly high. And so, for a lot of households looking to get into the housing market for the first time, turning to an adjustable rate product can be a very smart choice to bring down costs.
And right, and so when you go into an ARM, is the expectation that you're doing it for a period of time? You're not locking in an ARM for a 15 or a 30-year period.
So there are a few different ARM products out on the market, and I think there is some confusion on exactly how they're designed. So the most common products in the US housing market lock in your rate for a number of years and then they float thereafter. So they're often called a 5-1, a 7-1, or a 10-1 product. And what that means is that for 5 years, you have a fixed rate. And then once a year thereafter, the interest rate is going to change. And so what you're doing is you're kind of trading off some exposure to interest rate movement in the future, but you're locking in the rate for the short term.
How much difference is there usually in the actual rate between an ARM and a traditional fixed rate mortgage?
Well, it varies over time, but you see pricing differences anywhere from about 50 basis points to a full percentage point cheaper mortgage if you're willing to take on some of that interest rate risk in those future years.
How frequently do you see people going the route of going with the ARM these days?
So ARMs are still not all that popular. Generally, less than 10% of all mortgage buyers are taking on ARMs. You do see them a bit more popular in the jumbo market. So in the market of the most expensive homes that don't qualify for Fannie and Freddie mortgage support. So within that segment, that's the segment where the interest payments are the largest and where there's the most to save by going the adjustable route.
Because of the market being the way that it is right now, you said it's probably not too much a surprise that we're seeing some of this activity at the moment because people are willing to, I guess, play the rate game here just to see if they can get a lower rate for a period of time.
Absolutely. I think it's useful to sort of think about this trade-off between the benefits and the costs of a product like this one. The benefit is obvious. You're going to save in terms of your interest payments for that fixed period of time, whether that's 5, 7, 10 years. The cost is that when interest rates, where interest rates are going to be at the end of that time period is up in the air. And so that's really the trade-off, the risk that you're exposing to. But I think in the big picture, actually it's a surprise that more people don't use these products. These are products where they have a bad reputation because of things like the financial crisis. We can talk about the ways that those contracts were different. But these are actually pretty straightforward contracts. There are a few aspects of them that you need to understand. But in that period of time, 5, 7, 10 years, you're going to save a considerable amount on your interest.
Right. And as you mentioned, the perception of the ARM has changed quite a bit over the last couple of decades.
That's right. It's viewed, I think, still through the lens of 2008. And so there's a sense in which we tie all adjustable rate products to the teaser rates of the subprime boom, the negatively amortizing loans, and the loans that had these really sort of like exploding clauses in them, right? Where you'd see a large jump in your payments when that expired. That's not what these products are. These products are locking in your rate for 5, 7, or 10 years. And then thereafter, they are going to fluctuate. It's important to understand how they fluctuate, what rate they're pegged to, and so on, but they are not a short term exploding
But
contract.
for those that don't understand, you may, as you said, lock in that lower rate for that period of time. What should their expectation be for that fluctuation on the back end of that period of time.
Yeah, so now we're getting to the risk. So I think the savings here are very easy to convey. Relative to the 30-year fixed, you're going to pay less every single month in interest. But the risks are a little bit more opaque because who knows what interest rates will be, 5 or 10 years from now. We can't predict where interest rates are going to be in a month or two. So I think what we need to do is have a little bit of perspective and say, well, if rates come down, then you have the opportunity to refinance. So on the downside, you're protected in that sense. You would refinance just as if you were refinancing out of a 30-year fixed. It's really on the upside where you face the dangers. And that's where you want to think about potentially refinancing into another adjustable rate product that has this hybrid feature where it pushes out the date further. Or we can think about who this product makes the most sense for. It's going to make the most sense for people who expect to move or refinance within 10 years. If you're in a starter home, you're pretty confident that in the next 10 years, you're going to be moving onward to maybe another job or a larger house to fit a growing family. Then why pay to lock in an interest rate in the years that you're not going to be using the mortgage, right? So most people don't stay in the same mortgage for 15, 20, 25 years, and yet that 30-year fixed rate that you pay for, that's rolling in that cost for all the years. So I think that's really the trade-off.
Of the different lengths of time that are available for an arm, is one more attractive than the other in most cases for people? Obviously, knowing it's probably the individual's call as to what their scenario is, but do we see people trending to one of those more so than the other?
Yeah, at the end of the day, it really is an individual level decision about how sensitive you are to the price today and whether those interest costs are really the barrier to getting into the home versus your risk tolerance. Are you willing to face the interest rate risk in those future years? Certainly, the shorter time period that you lock in the rate, so that 5-year product, that is going to give you the biggest interest rate savings today, but it means you're going to be exposed to the market the soonest. And so as you're kind of planning around this, I think the 10-1 arm, the 10-year option where you lock in for 10 years and it floats thereafter, that's going to meet a lot of first-time buyers' needs when they're thinking about, how long am I going to be in this house? Am I likely to refinance in the next 10 years? Am I likely to move in the next 10 years? And so it's really thinking about those kind of trade-offs, but it really is trading certain savings right now for a very uncertain cost in the future.
But with the dynamics of what we're seeing right now in the marketplace, I guess the assumption has to be that this type of activity is going to be potentially more prevalent, at least in the short term.
Yeah, well, I think we're coming to maybe a distasteful realization that these higher interest rates are going to be here for a much longer time. And even where the interest rates are today, which are in the low sixes, that's still below the sort of the long-term average of where mortgage rates have been. So I'm sure some of the listeners will be familiar with where interest rates were in the early 1980s. But even over a long time period, it's very common to see mortgage rates in the sevens. And so, I think this is just a very slow realization that mortgage rates are not going to be back in the fours anytime soon. And we need to adjust to that reality. And one way to do that is by looking at alternative products.
My parents still cringe at some of the rates that they saw back in those days as well. So I totally get it. Hey, Ben.
Mine too.
Yeah, Ben, thanks very much for your time today. All the best.
Absolutely. Thanks for having me, Dan.
You got it. Ben Keys, who's a real estate professor here at the Wharton School.